Goldman Sachs just sent a note out to all its institutional clients, basically telling them which way the market's going to blow for the rest of October and for all of November. And I was reading this here as I was relaxing with Winston over here, and we're just back from like 2 trips, and I thought, it'd be an interesting thing to read. And I thought, this pisses me off. I tell you why it pisses me off, because why is this not in mainstream media? Why doesn't everybody have this data? And of course it is because the world isn't a fair place. So Winston said to me, well, why don't you just share it with people? Because we have here basically the 5 or 6 step roadmap to what's actually going to happen. So if you agree with me that we should all have access to the same data and information, let me know down below in the comments. Just write agree, and I'm going to walk you through it. I'm going to do one better for you even. I'm going to put the entire report in full into our free community. Just go there. There's a link down below, felixfriends.org/resources, and there's a link down below, and you have access to that. Just find the video and it will be attached to it. It's also a nice way for this community to stay alive should YouTube decide to ban us again, which they did last week if you hadn't noticed. So let me walk you through this here, and it's kind of probably starts with all the most important things, but I'm going to put the charts on the screen here for you. Hopefully my editor is going to do that. And to kick us off with this guy who's like their fund flow guru, sorry, very noisy cats. He's saying that October isn't going to be that great, but that November is going to be fantastic. That's also what Albert just dug out here in the research. And if you literally look back from 1928, so give or take 100 years, the rest of October is usually pretty choppy, and I'll put the chart on the screen here for you. But we then enter the golden period of the market, and a lot of people are starting to get scared because there's all this talk about the AI bubble and everything else. And again, they're not going to participate. So from the S&P, from now to the end of the year, has gone up 4% on average since 1928. The Nasdaq's done double that, 8%. That's pretty significant. So I put a chart on the screen here for you where you can see the S&P flow of funds from where you are right now to the end of the year. So does it make sense not to be invested? I don't think it ever makes sense not to be invested. Very, very, very few circumstances. I'm not saying you need to be 100% invested. I'm not saying you need to be 100% in the latest AI thing, but you look at this data and you're like, wow, I'm going to miss out on a lot potentially. And then you have, and this is where it gets a little bit more like intricate and insightful, mutual funds. US mutual funds have been huge sellers. Now they sell particularly towards their year end, and their year end is typically in October. Don't ask me why, I'm not a mutual fund guy, but they sell into that close. And that means that that is pretty much done. So it removes a big obstacle for the market. There's a second chart on here with some bar charts, and you can see that October, and it basically shares a share of mutual funds with fiscal year end in each month. So most of them are October. So October gets hammered pretty badly, and then November looks much better. And then number 3 here, and I hope you're taking notes. And by the way, if you're wondering, how can I use this information as an investor? The number one thing that you're getting wrong from like the thousands of people that I've looked at their portfolios for is you don't sell. So you don't, well, actually you do sell. You sell your winners really early because you're scared, but your losers, you hold on to them forever. If you just fix those 2 things, this thing goes away. And you can do that pretty simply just by following the same rules Wall Street uses. So it's not rocket science. You don't need to reinvent the wheel. You just follow the same structure, the same rules that Wall Street's been using for 50 years. You want to know what the rules are? All right, come and join me live on Tuesday, felixfriends.org/training. It's completely free. I'll run you through it. We'll go an hour or 2, and you'll walk away with those rules. That's my promise to you. But you've got to show up. If you don't show up, there's no replay. This is a no replay environment. I'll tell you why. People don't watch them. The people who take action actually show up. They're interested. They want to ask questions. They want to really see how it's happening in real life. If I send you a replay, you're just not going to watch it. Maybe you say, I'm different. Statistically, that's not very unlikely. Okay, number 3, buybacks. So corporate buybacks are the biggest single buyer of US stocks. How does that work? Say you are Apple. You're generating more money than you know what to do with, because innovation and R&D is a word you've yet to learn. Slight dig there at Tim. So what do you do with all the money? Well, you could pay out dividends, but most people don't like the dividend taxes that come with that. So the best thing you can actually do for your shareholders is just you buy your own shares. So what happens if you're a company, you buy your own shares? Well, you reduce the numbers of shares outstanding, which means if you're an Apple shareholder, you now own a bigger piece of the pie because the pie shrinks. See what I'm saying? And this is a cyclical thing. This happens throughout the year 4 times, a period where they buy a lot, and then there's 4 times a year a period where they stop buying. We're just coming out of they're not buying period. Why? Because we're at the beginning of earnings season. And that's the way the regulation works. So the estimates from Goldman Sachs are that on the 24th of October, write this down, but 40% of companies are going to start buying their own shares again. And then that's going to increase very significantly over the coming days after that. And there's a chart here, hopefully we can get that on the screen for you as well. You can see that. And what they're also saying is because Goldman Sachs arranges a lot of these buybacks, they're saying in the fourth quarter, our desk is more active with corporates usually looking to hit year-end buyback goals. So you're going to see more buybacks in Q4, which means the market is likely going to be more stable. It's likely to maybe even go up more than it ordinarily was in any other quarter. Now, I haven't got a crystal ball, nor do you, but I'm just telling you what the data is. And then the other thing we look at is money, right? I always say follow the money, and you can't go all that wrong. So the flows into mutual funds are showing there is a lot of demand for stocks. So global mutual funds last week bought $28 billion worth of stock, up $8 billion on the week before. So it tells you again, momentum is picking up as institutional, money is. And then let's jump to you. You are a retail investor. I am a retail investor. Winston down here is a retail investor. There should be some cats around here too who are retail investors. And you've heard of the phrase buy the dip, right? And it's become like a religion to people. So if you look at the last 3 months, there are literally only 5 times where retail became a seller. And I'll put them on the chart here. There's little red arrows there. So very, very, very rarely. And we had a pretty exciting couple of months here. So there were plenty of reasons to get scared. But retail is buying the dip again and again and again and again. And that, again, underlines a very strong market. So what about the institutions? What about the buggers on Wall Street? Well, those guys have more money than us, right? It's just a reality. The funds, the hedge funds, the banks have more money than us. So actually looking at what they're doing is probably more important than retail. And then I'll give you another little bonus nugget here as well. So there was a sentiment survey out there. And that sentiment indicator from Goldman Sachs has gone negative. It's literally negative. What does that mean? Well, I love buying stocks when Wall Street's negative. If you're just buying the index, say. Why? Because they're going to bounce back. You look at this chart here with the blue background is whether they are bullish or bearish, right? So it's at the top, it's bullish. At the bottom, it's bearish. And you can see that, yeah, maybe they'll go down a little bit more for a little while, but there is always a rebound. So if you're wanting to be a dip buyer, you kind of want to buy the dip when Wall Street's feeling a bit worried about, I don't know what, politics or something, right? So that's the way I look at that. And then bonus tip here, algo funds. So the computer-driven funds, they're called CTAs usually. They haven't been buying. They give us a beautiful start to the year and then they haven't been buying. So why do I like that? Because when they buy a lot, there is a high likelihood that they're going to sell. So we have these beautiful moments where all the money rushes in. And I'm always like, okay, make sure our risk management is in place because this is going to turn around. The tide's going to come in, it's going to pull back out. But they haven't been buying for ages, which means the likelihood is that there is an opportunity for them to start buying more. So what do you take away from this? Well, ultimately, October could be a little choppy. We're about to enter the best part of the year, November, December. Seasonally the strongest part of the year, 8% upside on the Nasdaq on average for the last, however long the Nasdaq's existed. And a lot of people are getting scared. So it's the wrong way around. And the way I look at that is almost the fact that they're not publishing this information and then they're not printing this on front page mainstream media. It's almost the story you need to know because it's sort of the manipulation to make sure that you are the exit liquidity and that Wall Street is well positioned for what's coming. So the more you understand a little bit the nuances of this, and you don't need to be glued to the news every day. Actually, that's probably very counterproductive. But the more you understand how these patterns work, because that's all it is. It's always a pattern. It's always pattern recognition. And that allows us to, I think, make smarter decisions. The more you understand that, the more skilled you become. And investing is nothing but a skill like any other skill. And once you realize that, once you accept that, well, now you're in charge. Now you can learn the skill. You no longer need to rely on Wall Street doing it for you, or the politicians, or somebody else. You actually become the person who is now in control. And that's kind of my goal here for you, is to give you that empowerment. So join the free community down below. I'll put the full report in there, and then you can read it with your own eyes, abridged. And there are a few more things in that report, by the way, that I've taken out because I thought they would bore the pants of 99% of people, but maybe you're one of those special ones who finds that interesting. And I wish you a beautiful start to the week. We're going to hang out here because I've missed these guys. We haven't seen each other in about a week, right? Is that right? Yeah, she doesn't seem that disturbed, does she? And come and join me live. felixprehn.org/training. All the best. 5 high growth stocks, so good that Winston thought we should keep them as a secret, but then he is a pretty generous soul. So we're going to walk you through the biggest opportunity I've seen in probably 10 or 20 years.